There is an idea in the world of finance that is so seductive, so intuitively appealing, that it has lured countless traders and investors to their ruin. It is the simple thought that enters a man's mind when a stock he has purchased begins to decline. If it was a good buy at 100, he reasons, then it must be a tremendous bargain at 90. This logic seems, on the surface, to be the very essence of sound investing, to buy low. But Richard Wyckoff, through his decades of intimate observation of Wall Street's inner workings, came to a starkly different conclusion. He identified this practice, the art of averaging down, as one of the most destructive and misguided strategies that an amateur can employ. He saw it not as a path to bargains, but as a direct route to financial suicide. This video is a deep dive into Wyckoff's uncompromising critique of this common practice. We will explore the truth about averaging down, dissecting the flawed logic and the powerful psychological traps that make it so dangerous. We will contrast the amateur's hopeful approach with the professional's business-like principles of capital preservation. This is a foundational lesson in survival, dedicated to understanding one of the most important rules of the market: how to protect your capital from your own worst instincts. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The entire theory of averaging down rests on a single dangerous assumption: that a stock's price and its value are two independent things, and that a decline in price automatically makes the stock a better value. The amateur believes that because a stock was, in his judgment, a good purchase at a higher price, a subsequent decline is merely a temporary market fluctuation that offers him the chance to acquire more shares at a discount, thereby lowering his average cost for the entire position. He pictures himself as a shrewd bargain hunter, taking advantage of the market's irrationality. Wyckoff, however, understood the grim reality of the situation. He knew that in most cases a stock's price declines for a very good reason. The price is not falling in a vacuum. It is declining because the intrinsic value of the company is declining, or because the market's largest and most informed operators, the composite man, have determined that its future prospects no longer justify its current price. When the price of a stock falls, it is often because the insiders, the directors, the bankers, and the large operators who know the true state of the company's affairs, are selling. The amateur who averages down is therefore not a bargain hunter. He is, in fact, providing a convenient market for the well-informed professional who is trying to get out. He is buying shares from the very people who have the best reasons to be selling them. This flawed logic is so prevalent and so destructive that it is exactly what Richard Wyckoff wrote about and dedicated an entire chapter to in his book, a new adapted edition of which you can find in the description of this video. He emphasized that before any purchase is made, and especially before a second purchase is made at a lower price, the trader must be able to answer the fundamental question: why is this stock declining? Is it declining merely in sympathy with a weak general market while its own technical position remains strong? Or is it declining because of some inherent weakness, some deterioration in the company's business, earnings, or competitive position? The amateur who averages down rarely, if ever, asks this question. He operates on the blind assumption that his initial judgment was correct and that the market is wrong. This, Wyckoff argued, is an act of pure ego, and the market has no respect for the egos of men. To understand why so many people fall into this trap, we must look beyond the flawed logic and examine the powerful psychological forces at play. Averaging down is not just a technical mistake, it is an emotional one. It is a strategy born of hope, ego, and an irrational attachment to one's own decisions. The first and most powerful of these forces is hope. When a trade goes against him, the amateur is paralyzed by the hope that the stock will come back. He cannot bring himself to take a small decisive loss, because doing so would extinguish that hope. Averaging down becomes an act of feeding this hope. By buying more shares at a lower price, he feels as though he is taking positive action. reinforcing his initial belief and giving himself a new reason to hope for a recovery. He tells himself that now he only needs the stock to rally to the midpoint of his purchases to get out even. But hope is not a market strategy. It is, as Wyckoff taught, the most treacherous of all human emotions in the world of finance. It clouds judgment and prevents the clear, objective analysis that is necessary for survival. The professional operator does not hope. He analyzes. And when the evidence proves his initial judgment wrong, he acts without hesitation. The second psychological trap is ego. No one likes to admit that they have made a mistake. Taking a loss is a direct admission that one's initial judgment was wrong. For many, this is a blow to their ego that they are unwilling to accept. Averaging down is a desperate attempt to avoid this admission. It is a way of doubling down on one's initial opinion, of trying to force the market to conform to one's own will. The trader is, in effect, arguing with the tape. He is saying, "I believe this stock is worth 100 and I will continue to buy it as it falls to prove that I am right." But the tape, as Wyckoff knew, is the final arbiter. It is the dispassionate record of the market's collective judgment, and it has no interest in any single individual's opinion or ego. To argue with the tape is to argue with the force of nature, and it is a battle that the individual trader will always lose. The professional, by contrast, subjugates his ego to the market's verdict. If the market tells him he is wrong by moving against his position, he accepts the verdict gracefully, takes his small loss, and moves on, his ego intact and his capital preserved. The third trap is emotional attachment. Once a person buys a stock, his relationship with it changes. He is no longer a detached, objective analyst. He is an owner. He begins to root for the stock as he would for his favorite sports team. He reads news about the company with a bullish bias, filtering out negative information and amplifying the positive. This emotional attachment makes it incredibly difficult to make a rational sell decision. Averaging down deepens this attachment. With each new purchase, the trader becomes more financially and emotionally invested in the company, making it even harder to cut the position loose. He is no longer a speculator. He has become an involuntary long-term investor in his worst-performing asset. Wyckoff taught that the professional must maintain a state of perfect emotional detachment from his positions. A stock is not a friend or a part of one's identity. It is merely a vehicle for speculation, an instrument to be bought and sold based on a cold and logical assessment of the evidence. To illustrate the devastating real-world consequences of this practice, Wyckoff recounted a story from his own experience that serves as the ultimate cautionary tale. It is the story of a friend, an otherwise intelligent and successful businessman, who was completely ruined by the siren song of averaging down. The story begins at the peak of the bull market in 1909. The friend, caught up in the speculative fever of the time, purchased a block of Union Pacific stock at a price of $219 per share. Union Pacific was one of the premier blue-chip stocks of its day, a leader in the market, and the purchase seemed, to the amateur, to be a sound one. Shortly after his purchase, however, the market turned, and the stock began a long and protracted decline. When the price reached $185, the friend, still confident in his initial judgment, saw what he believed to be a great opportunity. If it was a good buy at $219, he reasoned, it is a tremendous bargain at $185. He bought another large block of the stock, significantly lowering his average cost. But the decline did not stop. The stock continued to fall, and as it approached 160, the friend's conviction only grew stronger. He viewed the continued drop as a gift from the market, an even greater chance to acquire a wonderful company at a ridiculously low price. He bought a third, even larger block of shares at this level. His broker and his friends warned him, but his mind was clouded by the powerful combination of hope and ego. He was now fully committed, both financially and emotionally, to the idea that Union Pacific had to go up. The stock continued its relentless descent. As it fell through 150 and then 140, the trader's anxiety grew, but his flawed method remained the same. He held on, and at a price of 135, he made his final, desperate purchase, scraping together the last of his available capital to buy one more block of shares. He was now leveraged to the absolute limit, his entire financial fate tied to the performance of this single, disastrous position. The market showed no mercy. Union Pacific continued to slide, eventually reaching a low of 116. At this point, the trader's capital was completely exhausted. His brokerage firm was forced to sell him out, and he was left with nothing. He had, in Wyckoff's poignant phrase, gone out with the tide. Wyckoff's lesson from this tragedy was clear. The man's failure was not a matter of bad luck. It was the direct and inevitable result of a fundamentally flawed method. He had operated without any regard for the principles of sound business or capital preservation. He had no stop-loss. He had no risk management plan. His only strategy was to pour more and more money into a losing venture, a strategy that would be considered insane in any other line of business, but one that is tragically common on Wall Street. This story is the ultimate illustration of the truth about averaging down. It is not a strategy for acquiring bargains. It is a recipe for ruin. Having thoroughly dissected the flawed logic and ruinous psychology of averaging down, we must now turn our attention to the professional's alternative. The path of the amateur is clear. When a trade goes wrong, he applies more capital in the desperate hope of making it right. The path of the professional, as taught by Richard Wyckoff, is the polar opposite. When a trade proves to be wrong, the professional does not add to it. He eliminates it. He does so swiftly, decisively, and without emotion. This is not a sign of failure or indecision. It is the hallmark of a master operator. This section is dedicated to the Wyckoff alternative to averaging down. A complete system of thought and action built upon the bedrock principle of absolute capital preservation. It is the business-like approach that ensures survival, and in the stock market, survival is the prerequisite for success. The professional's mindset begins with the non-negotiable acceptance of rule number 3, always limit your risk. This principle, more than any other, is the antidote to the destructive practice of averaging down. The mechanism for its application is the stop-loss order. Wyckoff viewed the stop-loss not as a mere trading tactic, but as a fundamental tool of business management. It is a calculated, pre-planned action that stands in stark contrast to the emotional, hopeful inaction of the trader who is averaging down. Averaging down is an act of faith. Placing a stop-loss is an act of logic. The trader who averages down is essentially saying, "My initial judgment was wrong, but I hope the market will change its mind and prove me right later." The trader who uses a stop-loss says, "My initial judgment may be wrong, and if the market's action proves it to be so by hitting a specific price, I will accept the evidence and exit immediately." The former embraces uncertainty and hopes for the best. The latter defines uncertainty and prepares for the worst. In his writings, Wyckoff provided a powerful analogy for this concept. He compared the use of a stop-loss to paying a premium for fire insurance on one's house. A prudent man does not expect his house to burn down, but he willingly pays a small, known premium to protect himself from the devastating, unknown cost of a potential fire. The risk on a trade, the distance from the entry price to the stop-loss price, is that small, known premium. To trade without a stop is to leave one's entire financial house uninsured, vulnerable to the first unexpected market fire. The trader who averages down is like a homeowner who, upon seeing a small fire in his kitchen, decides not to call the fire department, but to instead move his most valuable possessions into that very room, hoping the fire will go out on its own. This professional mindset requires a complete reframing of how one views a losing trade. To the amateur who averages down, a loss is a personal failure, an attack on his ego that must be resisted. To the Wyckoff analyst, a small, controlled loss is simply a business expense. No business on earth has a 100% success rate. Losses are an inevitable and recurring part of the operating expenses of trading, along with commissions, taxes, and interest charges. When a stop-loss order is triggered, it is not a moment for regret. It is a moment of successful execution of a sound business plan. The plan was to risk a small, predetermined amount to test a trading thesis. The market proved the thesis wrong, and the stop-loss did its job perfectly by closing out the position and preventing a small, manageable expense from turning into a catastrophic, capital-crippling disaster. This discipline was a common thread among all the great operators Wyckoff observed. He noted one persistently successful trader who never placed an order unless it was accompanied by a 2-point stop order. E. H. Harriman, the master railroad builder, was known for his advocacy of the absolute limitation of risk. The greatest minds in the market did not fear taking a loss. They feared taking an uncontrolled one. From this philosophical foundation, we can derive a series of practical principles that guide the professional operator and stand in direct opposition to the amateur's habit of averaging down. The first of these is Wyckoff's view that capital is a trader's lifeblood. It is the raw material of his business. It is his inventory, his stock in trade. To waste it on a losing proposition is the equivalent of a manufacturer willingly destroying his own machinery or a merchant setting fire to his own goods. The primary objective of a trading business is not, in the first instance, to make profits, but to ensure that the capital of the business is preserved so that it can operate another day. The practice of averaging down violates this principle in the most egregious way. It is the act of throwing good money after bad. It directs the most valuable resource a trader possesses, his capital, into his single worst-performing asset. This leads to one of the most insidious and damaging consequences of averaging down, the problem of frozen assets. When capital is tied up in a losing position that is being averaged down, it becomes frozen. It is locked in a state of hopeful paralysis, unable to be deployed for new, more promising opportunities. The market, Wyckoff taught, is a continuous stream of opportunities. On any given day, there will be stocks that are on the springboard, completing their period of accumulation and ready for a significant advance. The trader who has his capital frozen in a losing trade, hoping for it to come back, cannot act on these new opportunities. The cost of averaging down is therefore not just the monetary loss on the bad trade itself. It is also the opportunity cost of all the profitable trades that could not be taken while the capital was imprisoned. A trader who cuts his loss short, on the other hand, keeps his capital fluid and dynamic. He may have taken a small loss, but his capital is immediately available for the next high-probability setup. He is able to turn his inventory over. He can move from one opportunity to the next, constantly seeking the most efficient and profitable use for his funds. The trader who averages down becomes an involuntary, long-term investor in his worst idea, while the professional who cuts his losses remains a nimble, opportunistic operator, ready to seize the best the market has to offer. Wyckoff himself exemplified this principle in his personal operations. He made it a practice to use only a small percentage of his total available capital, typically no more than 5 or 10% for his active trading endeavors. The bulk of his capital was invested where it was safe, returning an income, and likely to appreciate. This was his backline of defense. This deep respect for capital, and the understanding that its preservation was paramount, is a defining characteristic of the professional mind. The destructive habit of averaging down is also directly linked to the sin of overtrading. In his extensive analysis of market failures, Wyckoff concluded that 85 to 90% of them were due to overtrading or a lack of capital, which, when boiled down, are the same thing. Averaging down is a particularly dangerous form of overtrading. It is the act of making a trade that is too large for one's capital, not all at once, but in a series of escalating errors. It is doubling down on a mistake. The trader who buys 100 shares of a stock and sees it decline has a single manageable problem. The trader who then buys another 100 shares at a lower price now has twice the position and twice the risk, all while the market is actively proving his judgment to be wrong. This compounds the pressure, distorts judgment, and dramatically accelerates the rate at which capital is depleted. It violates the core Wyckoff principle that one must learn to trade successfully with a small amount of capital before ever attempting to use a larger amount. Averaging down does the opposite. It applies an ever larger amount of capital to a failing idea. The alternative, which Wyckoff championed, is to build up one's capital out of profits, not to deplete it by feeding losses. The trader who starts with small commitments and demonstrates success can gradually increase his trading size. His growing capital is the proof of his sound judgment. The trader who averages down is in a constant state of capital depletion, his shrinking account a testament to his flawed method. The professional builds his business on a foundation of small, controlled losses and a growing base of capital. The amateur who averages down builds his position on a foundation of hope and finds himself presiding over the liquidation of his own account. The one specific exception to the rule against buying more of a stock at lower prices was a method Wyckoff occasionally used, not for his active trades, but for a long-term investment that had turned against him. This distinction is of the utmost importance. A trade is a short to intermediate term speculation on a price movement, based primarily on technical, market-driven evidence. An investment is a long-term commitment to a company, based on a deep analysis of its intrinsic value and future earning power. Wyckoff detailed a personal experience in his writings that perfectly illustrates this advanced concept. He had purchased a stock as an investment at a price of around 45. Sometime later, due to unfavorable market conditions or manipulative pressure, the stock declined significantly, eventually reaching a price of 15. The amateur, practicing conventional averaging down, would have bought more stock at 40, more at 35, and so on, tying up an ever larger amount of capital in a losing venture. Wyckoff did the opposite. He did nothing. He waited. The first and most critical prerequisite for his method was this. He had to be absolutely certain, through his own continuous and deep investigation, that the fundamental condition of the company was improving even as its stock price was declining. He needed to know that its debt was being reduced, its earning power was increasing, and its intrinsic value was growing. If this condition was not met, the stock was simply a bad investment, and the only logical course of action was to sell it and take the loss. However, if the fundamentals were sound and improving, he would then wait for the technical picture to show that the decline had run its course. He would look for a selling climax, a spring, or some other evidence that the liquidation was complete and that a new demand was beginning to emerge. Only then would he act. But he did not simply buy more of the stock to lower his average cost. His method was far more intelligent and active. At a low price, say at 15, he would purchase an equal amount of the stock as his original position. He now held two lots, one with a large unrealized loss and one bought at the bottom. He would then patiently wait for the inevitable technical rally that follows a market bottom. As the stock rallied, say to a price of 25, he would sell the new lot of stock that he had just purchased at 15. This single transaction would yield a profit of 10 points. He would then take this 10-point cash profit and apply it to his original troublesome position, thereby marking down its cost basis. His first lot, originally purchased at 45, now had an effective cost of 35. He had actively used a short-term trade to repair a long-term investment without adding a single dollar of new permanent capital to a losing position. If the stock were to decline again to a low level and his fundamental analysis remained positive, he could repeat this process, gradually reducing the cost of his original shares until he could eventually exit the entire position at a break-even or even a small profit. This, Wyckoff stressed, is not averaging down. It is an advanced, active strategy for working out of a disappointing long-term investment. It is a repair job to be undertaken only by an expert analyst who is certain of his fundamental value analysis and who has the skill to time his purchases at the bottom of a swing. With that rare exception addressed, we now turn to the true Wyckoff method for adding to a position, the professional strategy of averaging up or pyramiding. This is the polar opposite of averaging down, both in its mechanics and in its philosophy. The logic is simple and unassailable. The professional adds capital only to his winners, not to his losers. He adds money to a trade only after it has already proven his initial judgment to be correct and is showing him a profit. He acts from a position of strength, not of weakness. The amateur who averages down is governed by hope. The professional who pyramids is governed by evidence. Pyramiding is the art of skillfully compounding the profits on a successful trade by using the market's own momentum to increase the size of one's position. However, this is not done randomly. Wyckoff taught that there are specific, logical points in a developing uptrend where it is safest and most effective to add to a position. The ideal time to pyramid is during the breakout from a period of reaccumulation, or a stepping stone. As we have discussed, these are the smaller trading ranges that form as a stock rests and consolidates its gains during a major markup phase. A breakout from one of these stepping stones is a confirmation that the primary uptrend is resuming. This point offers a logical, low-risk opportunity to add to one's line. The technique of pyramiding requires careful management of the stop-loss order. With each new addition to the position, the stop-loss for the entire line must be moved up to protect the new capital being deployed. For instance, if a trader's initial purchase was at 50 with a stop at 48, and he pyramids by buying a second lot on a breakout from a stepping stone at 55, his stop for the entire now larger position might be moved up to 53. This ensures that even if the new trade fails, the profit from the original trade is protected. Wyckoff provided an excellent example of this technique from his own trading in U.S. steel. Expecting a sharp move, he would initiate a position with, for example, 300 shares, protecting it with a 3-point stop. For every 2 points the stock moved in his favor, he would then buy another 100 shares, protecting each additional lot with its own 3-point stop. After the stock had advanced about 10 points, he would stop buying and begin to trail his stop-loss up behind the entire position to protect his accumulated profit. This method of averaging up into a winning trade is the hallmark of a confident professional operator. It is a strategy for maximizing profits by aggressively pressing an advantage when the evidence is overwhelmingly positive. It is the true Wyckoff way. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with clear explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. In conclusion, the professional's approach to capital management is a world apart from the amateur's. The truth about averaging down is that it is a psychologically seductive but logically bankrupt strategy that consistently leads to ruin. It is an act of hope in the face of contrary evidence. It violates every principle of sound business by throwing good money after bad and locking up capital in failing ventures. The Wyckoff method provides a clear and powerful alternative. It is a methodology built on the bedrock of capital preservation, ruthless risk limitation, and the intelligent application of capital to positions that have already proven themselves to be correct. The amateur adds money to his losers because he is unwilling to accept a small loss. The professional adds money to his winners because he has the courage to pursue a large gain. This single fundamental distinction in strategy and mindset is what ultimately separates the few who achieve lasting success in the financial markets from the many who are destined to become, in Wyckoff's poignant phrase, Wall Street ghosts.